welcome to the show.
All right.
Your TSP Weekly Podcast. Coming to you live.
From the bowels of Northern Virginia somewhere.
Bowels, that's right. I think the whole Northern Virginia area is our bowels.
Northern Virginia is kind of what has always been the recession-proof part of the country. It's kind of on pins and needles right now.
Yeah, it's starting to feel it a little bit. All right, man, let's get into it, though.
Yeah.
What do you got? We got a lot?
There's a lot. And but I asked you earlier if you had ever heard of the All In podcast. So
I don't think I have.
Yeah, I'm gonna write about this on the newsletter this weekend. So if you're a subscriber, you'll get it. If you're on our email list, you'll get it. So definitely get on there and check it out. But the All In podcast. So there are four VC tech entrepreneurs in Silicon Valley that used to get together for poker games, and and COVID comes around, and so they can't get together anymore, and so they start doing this podcast. And four guys, you wouldn't know them probably. You can check it out, but anyway, one of them is David Sachs, who now is the crypto czar for the administration. Okay. And the other three, well, one of the other guys you might have heard of, Shamath Palihapitiya.
Yeah, I recognize these guys' faces. I'm looking it up.
Yeah.
Wish I could do like Joe Rogan and pop this on the screen.
Yeah.
One of these days it might get that fancy.
We have to get a guy.
Yeah, we need a real producer.
So anyway, these guys, their podcast is great. They've had Ray Dalio on there. They had RFK Jr. They've had a bunch of people, but they're all like high end people. They had Trump on their podcast as one of the ones that he was hitting during the campaign. So they were at the White House last week, and they interviewed the Treasury Secretary and the Commerce Secretary, and these are like the most two recently posted podcasts for their All In podcast. If you want to get an idea of the structure that's going to happen going forward for the market, those two podcasts are an absolute must-watch. The Treasury Secretary, the guy is as straightforward as you can be, and he talks about his background stuff. He was working for George Soros, okay, in Soros' hedge fund. At the same time, Stanley Druckenmiller was working for Soros. So this is like the 70s. Those three guys are probably, the stories that he talks about in that podcast are unbelievable. And this guy knows what he's doing. As a Treasury Secretary, he's the best guy that we could possibly have in that position.
So I see a few actually recent ones, but so I don't want to tell people the recent, because the most recent one has Andrew Schultz, the comic on it. But tariffs, Trump's economic endgame, market chaos, Bitcoin reserve. Yeah, that's the one you're talking about.
Yeah, there's one with the Treasury Secretary and one with the Commerce Secretary.
Okay. Yeah, I'll try to put the links in the description below.
Yeah. So in the newsletter, I'm going to do the highlights of both of those podcasts. But if you want to, the point is, I don't want to spend too much time talking about this, but the point is, if you watch those two podcasts and try to set your politics aside.
Yeah, you gotta be able to do that.
Yeah.
Just listen to what the people are saying. Yeah. I'm all about that stuff. I agree. I mean, people will tell you what they're going to do. Between Trump,
Lutnick, the Commerce Secretary, and
you just got to be able to listen and not pick up, not get. I hate the word triggered. It's but it's you can't get sidetracked by a couple of little issues that they bring up. Right. Just listen to the people. I mean, I try to do that as much as I can. If I can find an interview with someone where they're telling you what they're going to do. Yep. Right. I've done that a lot with Michael Slayer lately. Mm-hmm. I want to hear. What's your big game, right? This is the guy. If you guys aren't familiar, it's the guy that he's not the CEO of MicroStrategies anymore. He's just the chairman, but he let somebody else run the company. But he's all in on Bitcoin, and I know we bring up Bitcoin a lot, but we mostly do because it's become an asset class within all of this that is something to watch. It's nothing to do with like cryptocurrency and, buying pizzas on with Bitcoin or whatever. But not to get sidetracked, but the point here is, yes, listening to people, listen to what they're saying. They're telling you, they're giving you the answers, particularly when it comes to politics and policy. Normally people like that, so they're not politicians. They're policymakers who've been brought in to carry out a policy. And if they're telling you what they're going to do, you better listen.
Yeah, they're business guys.
Yeah,
so Treasury Secretary was a hedge fund manager in Soros's company with Druckenmiller. Like, it doesn't get any better than that. He's all about making money. He's all Wall Street, right? And the Commerce Secretary was the founder of, I'm not going to remember the name of the company. It was a really big company on Wall Street. He lost basically.
What's his name?
Howard Lutnick. To be honest, I haven't finished watching that episode yet, but he talks about 9/11, and he lost like 2/3 of his staff on 9/11, and talked about how he got to know Trump and like the whole thing. But these guys are implementing the country in a direction. You may not like the direction, but they're telling you exactly what they're doing. And that's not a timing tool. It's not saying that the market's going to crash, but
I mean, what are the highlight? What was your big takeaway?
Yeah, so Treasury Secretary comes out and says 18 months before so Trump decides he's going to run, and like 18 months before Bettner, whatever his name is, Treasury Secretary, goes down to Mar-a-Lago, has a conversation with Trump. Trump says, I want to know how I can get us out of this debt spiral that we're in without causing recession. And Treasury Secretary is like, it can be done, and these are the things that we're going to have to do it. And he lays the stuff out in the podcast. And that's why, like on CNBC and Bloomberg, they're all freaking out about, Trump's calling for a recession. He's trying to crash the market and all that. They tell you straight up, they're not worried about the stock market. They want to see onshoring. They want to get certain things done. I don't want to go into it because it gets political really quick. But they want to get certain things done that they think is going to be in the best interest of the bottom 50%. As opposed to the top 50% that have been making a ton of money for the last 40 years. And so they are less interested in what happens to the stock market. They don't want it to crash. They're trying to, that's Treasury Secretary's job, is to try to like land the plane, right? Make it so that the market doesn't crash, but make a big shift in what's happening in the economy. So they're telling you the goal is not to crash the market. But if it does, they're not worried about that. That's not their goal. There's no Trump put. There's no, which is why you get 5 consecutive down weeks in a row. Which when I asked ChatGPT this morning, when was the last time we had 5 consecutive down weeks in the S&P 500? It came back like probably never. Like you can probably go back to 2008.
You fried its brain.
I did. It basically said that only happens when you're in the midst of a crash like 2008. Which we're not in. It's fascinating. So the bottom line is, if you still think that we're in this environment that the market always goes up, just look at what these people are telling you. Their goal is not to make the market go up. It's not to make it go down necessarily, but it is not to make the market go up. All right, way too much other stuff to talk about, but definitely check out those podcasts. They're awesome. All right, so we'll do real quick what happened this week. We also had a Fed meeting, which, to be honest, the Fed everybody was like on the edge of their seat about Fed meetings, and now if they should be more on the edge of their seat with these interviews that the Treasury Secretary and the Commerce Secretary do. I want to talk about somebody posted something on Facebook, and I want to kind of bust this myth about that. We're going to compare 2018 versus 2025 because 2018. It's all the same players. You had Powell was the Treasury Secretary, or Powell was the Fed chairman. Trump was the president. You had tariffs. It was the first time we did aluminum and steel tariffs on China. It was around the same time of the year. There's a lot of similarities, and we can see, what happened in 2018 versus 2025. Get another little take on seasonality, and then TSP fund charts. So Monday, New York State Manufacturing Index fell 20 points versus a positive 7 points last month. And the forecast was for a positive 2 points this month. So manufacturing is looks like it's starting to roll over. S&P was up 0.7, but this is kind of what it looks like. So we talk about there's the manufacturing side and the services side of the economy. As long as you're above 50, or in this case the zero line, that part of the market is expanding. So November was really good, right? And it looked like we were starting to get, because we had been a lot, going backwards, there had been a lot of yellow. We had been below the zero line for a while. Manufacturing started ticking back up. It looked like things were getting better. This is a bad candle right here. So manufacturing, if that starts rolling over again, which it looks like it is, it's not a good sign. Housing starts on Tuesday. We're up 1.5 million versus 1.35 million last month, and 1.34 million expected. So more houses are getting built, which, the Toll Brothers of the world are expecting people to start buying houses, which maybe they expect rates to come down. I don't know. But if I was Toll Brothers, I don't see how people are going to start buying more houses, but that's the way it goes. S&P's down a little over 1%. Wednesday, 30-year mortgage rate was up to 6.72% from 6.67. The mortgage rates had been falling for the last few weeks, and they ticked up this week. So, of course, new applications dropped 6.2% versus they were up 11% the week before when rates had been down. And then Wednesday, the big thing was the Fed, the FOMC announcement and the press conference after it, and the S&P was up 1.09%. Thursday, we get initial jobless claims at 223,000 versus 221,000 last week, so not a big move really. Continuing claims are 1,859,000 last week versus 1,892 this week. So again, not a big move in unemployment, which unemployment's going to be the last shoe to drop if it happens. S&P was down 0.2. And then Friday, there was no significant economic data, but it is a triple witching day, which means stock options, stock futures contracts, and stock index options contracts all expire on the same day. And it a lot of times it makes the market go up and down. There's a lot of volatility within the day. And so the market gapped down at the open 1%. And as we're doing this here at around noon on Friday, the market's down still about 1%. All right, so what the Fed said, they basically downgraded the U.S. economy and upgraded their inflation expectations. So they lowered growth expectations, right? I think we talked about that within the last couple of weeks. The Economy Now app, it's the Atlanta Fed came out and said there's the expected first quarter growth was a negative 2.8%, something like that, and a lot of it kind of got pushed onto tariffs. But 2 consecutive negative GDP quarters is the definition of a recession. So we'll see how that goes. But the Fed says lower growth expectations for the rest of this year on increased uncertainty, which I think things are getting pretty certain. If you actually watch those 2 podcasts, things are getting pretty certain. It's certainly going down is what's happening. And so the Fed maintained the current Fed funds rate at between 4.2 and 4.5%. So they kept rates where they are. And Powell says they're well positioned to move rates in either direction. They're going to continue to be data dependent. So they have 2 mandates, the Fed does, right? Price stability, which is the inflation side, and full employment, which is the employment side. And so if they, on price stability, if inflation goes up, because everybody's talking about how tariffs will increase inflation. If inflation goes up, the Fed needs to raise rates to maintain price stability. If unemployment goes up, the Fed needs to lower rates to stimulate the economy, stimulate businesses to manage unemployment. So it's like a seesaw, and right now they kept rates the same, and they're looking at both mandates. Sometimes they look at one more than the other, but I don't know. The Fed's in a trick bag. Next meeting is May 7th. Okay, so we see this all the time on Facebook. The buy and hold idea. This is one of the things that comes out all the time. The market can be down. It doesn't matter how much, and we'll have one up day, and people will jump in and say, "See, if you get out, you miss the up day." Yes, you missed the up day. So I went back into ChatGPT and some other research, and I'm like, okay, because I had read about this before, but missing the best 5 days of a year versus missing the worst 5 days of the year. Okay, are you better off if you miss the worst days, or are you better off if you miss the best days? So somebody posted this on Facebook. It was last Friday, March 14th. So days like today are exactly why you stay put and ride the wave. Right. So this I pulled up from HartfordFunds.com, and there's plenty of this on the internet you can find. Good days happen in bad markets, right? S&P 500's best days from 1995 to 2024. 50% of them are during a bear market, right? During the first 2 months of a bull market, it's 28%, and during the rest of the bull market is 22%. So the vast majority of the best up days happen during a bear market or the first 2 months of a bull market when we're coming out of the bear market. Which kind of makes sense, because as the market crashes, the quick recovery days tend to go up a lot, right? But first you have to have the big move down before you have that big recovery day. So if you look at this, right, missing the best days in the market has been costly. So your returns from 95 to 2024, if you missed the best 30 days from 1995 to 2024, your returns were 83% less than they would have been if you had just stayed in the market the whole time. So everybody, and you can go to the internet, and it's got a ton of this. It talks about how bad it is to miss those best days of the market. That is half of the story. If you missed, all things being equal, if you missed those 30 days, the best 30 days, your rate of return would be 83% less than it would have been if you had just rode the S&P the whole time. Okay. So this one was from investing.com, right? The analysis of missing out of the best 10 days of the market is steeped in myth of the benefits of buy and hold investing. As a strategy, buy and hold works great in a long-term rising bull market. However, buy and hold generally fails as a strategy during a bear market for a straightforward reason, psychology. Okay. I don't want to read this whole thing. Avoiding the worst days is a better endeavor. If the best days occur during the worst periods for the market, right, does it not become more logical to focus on avoiding those periods? While missing the best 10 days of the market certainly does impair portfolio performance over time, what about missing the worst 10 days? Okay, how important is this? Over an investing period of about 40 years, missing the best 10 days would cost you about 50% of your capital gains. But successfully avoiding the worst 10 days would have led to a 2.5x the gains over buy and hold. Right? So this is what that looks like. This is a chart of the S&P. It's a logarithmic chart. Okay? So this is a chart of the S&P 500. So if you had held the S&P 500 back here from 98 to whatever, 2023, the blue line is missing the best 10 days. Okay, so if you missed the best 10 days of the market, all other things being equal, you're way underperforming the market, right? So that's the argument. You want to be in the market during the best 10 days, because if you miss them, this is where you are. You've way underperformed the market. On the other hand, if you missed the worst 10 days, if you were out of the market during the worst 10 days, you hugely beat the S&P 500. Hugely, okay? Your outperformance of the S&P 500 by avoiding the worst days it is what it is. It's much more important, okay? So this one I went to ChatGPT and I asked it, what affects your portfolio more? Missing the worst 5 days or missing the best 5 days? Pretty simple question, right? The impact of missing the best 5 days versus missing the worst in a given year on your portfolio is significant, but they have opposite effects. So I kind of just wanted to get to this. Which has the bigger impact? Historically, missing the worst 5 days has a far greater positive impact on your performance than missing the best 5 days has a negative impact. A study by JP Morgan and other financial firms found that missing the worst days increases returns more than missing the best days reduces them. So the S&P 500 performance over time, if you're fully invested in the S&P from 1990 to 2020, your annualized returns were about 7 to 8%, right? If you miss the best 5 days of the year, your return drops significantly, sometimes below 3%. If you miss the worst 5 days of the year, your return improves dramatically, often exceeding 12 or more percent. So the conclusion is avoiding the worst 5 days is more beneficial than missing the best 5 days. However, since the best and worst days often cluster together, trying to time them is extremely difficult. A disciplined investment strategy like trend following or risk-managed investing can help mitigate downside risk without missing key upside moves. This is really the bottom line. You want to be in the market, you want to be in the stock funds when it's trending up, and you want to manage downside risk when it's trending down. This is what it actually looked like at the time. So we were at the peak, February 19th, I think it was. We fell 10.33% really fast, down to, I can't remember what that date was there, but this was the day that person was talking about, right? We had fallen 10.33%. We had a gain on Friday, March 14th of 2.07%. We then come up, hit the 200-day moving average line 3 times, get rejected 3 times, and this is today, Friday, the gap down. So, yes, would it be great to be in the market on a 2% up day? Yes. Would I worry about missing a 2% up day if I could have avoided a 10% decline? No. Right. Okay, 2018 versus 2025. So this is what 2018 looked like. Not too dissimilar, really, from how we came in. I mean, the last 2 years were huge, right? And then we also had big rallies going into 2018. And this is January 2018, right? So that's just kind of what it looked like. So what happened? February 2018, we had rising interest rate fears. There was a big spike in the VIX. It actually went up 100% on February 5th, 2018. It was one of the biggest moves in the history of the VIX. You had a whole bunch of algorithmic selling based on this big spike in the VIX. And then as we saw in the chart, January was already really overbought. So the conditions were already there for the market to fall. And as a result, the S&P fell 10% from January 26th to February 8th. Okay, but then it rebounded to new highs, right? So the key takeaway was the February 2018 sell-off was not caused by fundamental economic weakness, but rather a combination of rising interest rate fears, volatility-driven selling, and overbought market conditions. All of that we had this year going into 2025. It was one of the first major instances of how complex financial products like inverse VIX funds and other algorithmic trading could accelerate market moves to the downside. Interesting thing here was that it hit that 200-day moving average line and stopped, right? rolled over, came back, hit the 200-day again, and stopped. Right? It kept getting support at the 200-day. On March 18th, 2018, okay, so on March 1st, 2018, Trump announces his intention to impose a 25% tariff on steel and 10% on aluminum. So he does it in a tweet on the 1st, and he says, trade wars are good and easy to win. On March 8th, he signs an order to impose tariffs that are going to be effective 15 days later. So that all that talk about tariffs has an effect, like it has in 2025, also had that effect in 2018. The interesting thing is, this is where he does the tweet. It was right here. And this is where the tariffs take effect. So it's almost the same, because we know that April 2nd is the day the tariffs are supposed to start taking effect in 2025. So if it goes along with what happened in 2018, that is going to be the bottom. Because he's been forecasting it, right? So when it does actually take effect, in 2018 at least, that was the bottom. Okay, so later in the year, right? Now we're looking at this part. Okay, once we bottomed from the tariff concerns, the market started moving higher. Okay, then we had this whole big thing in 2018. So Fed rate hikes and hawkish policy stance. So the Fed was going to start raising rates. Powell came out and said we're a long way from neutral. That was on October 3rd. That really spooked the markets. They were still worried about the tariffs with China. Global economic slowdown was a worry. They were worried about recession fears. All the same kind of stuff they're talking about now. Market liquidity was really the biggest thing. So in December 18, market liquidity dries up, contributing to extreme volatility. S&P fell 9% in December alone, making it the worst December performance since 1931. We had the Christmas Eve crash. S&P fell 2.7% in a half-day session, worst ever performance for a Christmas Eve. But it was followed by a historic 5% rally on the 26th after reassurances from the Fed and White House officials. And then major earnings and growth concerns, which is what Powell was talking about at this Fed meeting this week, right? Same kind of thing as 2018. So the key takeaways from the second half of 2018, S&P drops 20% from its high in September to the low in December. It was the worst fourth quarter performance since 2008. NASDAQ entered a bear market, was down 23%. December was the worst month for stocks. December 2018, worst month for stocks since 2008 financial crisis. So everything was bad. But it's just really interesting to see if we follow along the same path that we did in 2018. From a technical analysis perspective, that 200-day moving average line is really, really important. We didn't get below it, until the big kind of the first move down, and then the consolidation, and then the second move down in 2018 into the bottom in December. Anything below the 200-day moving average is bad. Nothing good happens below the 200-day moving average line. All right, and it also kind of goes to seasonality, right? So this is a little bit of a different take from Sentiment Trader. This is all years, so the average of all years, right? And this is the current year that we're in right now in the red. So if you average all years together, forget like last week we talked about the post-election year. If you average all years together, this is what you get. Usually you get a run up in the beginning of the year, some kind of correction into April. Then you have a big move up into, early in the summer, which is why this is the end of the best 6 months of the year. And you start the worst 6 months of the year going forward, which is captures all this. And then starting in November, you start to get the best 6 months of the year again. So from a seasonal perspective, we should be beginning a move higher. Okay. We'll see what happens, but if you discount all of the, well, if you if you don't know the structure of what the administration is trying to do, if that wasn't happening, then this is what should play out. I just find it hard to believe that it's going to play out the same this time. Okay, TSP fund charts. So this is as of Thursday's close. So chances are it's not going to look exactly like this, because the market is down about 1% as we're recording here. So if it closes where it is right now, we will not be up 0.45% for the week. We will be negative a little bit for the week. We've been talking about this here for several weeks. We got below that 20-week moving average line, I don't know, like 3 weeks ago. And so nothing good. Once you get above that 20-week moving average line, we keep getting support there all the way along. Once you break below it, nothing good is happening, right? This is a pretty big deal. We're pretty far below that 20-week moving average line and well below 50 on relative strength. S-Fund, it's coming off like a waterfall. You know, you get this 1, 2, 3, 4, 5 should be next. And you're way down here at 40 in relative strength. There should be some kind of corrective move back up here before we get another wave down. I don't know. We are way past due for some kind of recovery rally, but I don't know. We shall see. iFund is still holding up, but it depends on what happens with the dollar. And the dollar looks very toppy. So obviously the iFund chart is the best looking of the stock funds. It's not cascading off, but if stocks really do roll over, the iFund will roll over with it. And the F fund is one that if you're in this thing for the long term, if you watch those two podcasts, the Treasury Secretary is telling you one of the goals is to lower long-term rates. They talk a lot about how Janet Yellen, the former Treasury Secretary, was financing government operations by selling short-term Treasury bonds. Usually they do it by selling long-term Treasury bonds. They were selling short terms for a specific reason, which was pumping a bunch of money into the system, which kept the market moving higher. And the new Treasury Secretary, he's like, no, we're gonna start buying longer dated bonds. It's gonna take money out of the system. It's gonna be harder for stocks, but it means rates are gonna come down. If rates come down, the F fund goes up. So if you just want to ride out the sort of the macro story, go F fund and ride it. You're much better off riding the F fund than you are riding the C fund right now. And then, of course, the G fund is kind of the biggest no-brainer there is. You're going to get, 4.5 right now. It's like 4.5% with absolutely no risk. Okay, questions?
A lot to soak in. If you guys have questions, best thing to do is put them in the comment section wherever you find this video. Yeah. Go back and watch that last 2-3 minutes there with what Jerry was talking about, because I follow a lot of analysts that are outside of the TSP. Our day job is a TSP, but we have investing life outside of it. And, one of the things everybody is clamoring for in the I would say outside of the TSP world when it comes to investing, meaning, you go to your financial advisor and a lot of people know they should be in cash right now, right? The problem is for the average financial advisor, they don't have access to something like the G fund. Yep. So what they're basically doing is telling you, find the best, savings or checking account that can give you whatever, but then you got to take it outside of their control, which you really don't want to do. And that's not just so they can maintain control. It's usually the best thing to do, because then it starts to get kind of wacky. The other thing they're doing is, you look at other options. Well, here's the thing. This is where I'm going with this. Smart custodians have gotten together and figured out ways to create things like the G fund. One in particular has a cash account now that is guaranteed 4%. right?
Really good.
Oh, it's phenomenal.
Yeah.
We know a bank, Roger Bank, is focused on military folks, service members mostly, right? Young service members in particular, and I can't remember the exact percentage, but their savings account and checking account,
it's like 4%.
Yeah, I know I thought it was close to 4%. Like that's massive. Yeah. If you don't realize how important that is in times like this. The ability, now we have the ability in TSP. I'm pointing this out mostly because I want you to see how good of a deal that is. Yeah. That other people outside of the TSP are scrambling to build ways to guarantee something like 3 to 4%. Yeah. That's massive, right? Instead of 0.001%, is what you're getting out of your checking account or whatever. So you really have to get over this long-term idea that the G fund is a bad idea.
Yeah. It's a tool. I mean,
it's just another fund.
Yeah.
And if a fund is going to give you a guaranteed, anywhere near 4%, and the rest of the funds are giving you negative returns, it should be a no-brainer, but people are just locked into why would I do that? And here's the thing. You can do it without any fees, any transaction fees, any commissions. Like it's beautiful. You can literally just go over to the G Fund at any time, whether you have moves left or not, right?
Yep.
So I'm hoping everybody isn't tuned out of this last 2 minutes. Can back up before my 2-minute rant. Listen to Jerry's again. F and G right now are something, that you should be using as tools. And not to say that you should go into the F fund, but if you go listen to these policymakers and what they're saying, if they're able to carry it out. Now, we don't know if they'll be able to carry it out.
That's right. That's true.
The market nowadays, because there's just so much access to the market that we didn't have 15 years ago, meaning I could trade money easily now on my phone or whatever. Access is higher than ever. If the market says, F you, we're going to do this anyway, well, that's a competing thing. But anyway, watch us every week, and you can get to listen about these things. And so if you like it, share it with your friends. Shoot us some questions. We love to get them, and we will see you guys next week.